Hi, this is James Eng of Old Capital, and today we're going to give you an update on multifamily market and also the financing market and where we're seeing transactions. So we haven't done this in a couple of months, so I thought it'd be a good way to get started. Um, my background, sort of born and raised in Houston, went to school at UT Austin, lived in DFW since 2006, and have been on the underwriting side with GE Capital, and then also the last 6 years, been with Old Capital originating multifamily loans. So done close to $1 billion now across 140 properties, totaling over 15,000 units. And then also invest as a limited partner across multiple properties in DFW, Austin, and San Antonio. So let's just start with the market update. So sort of high level economics, jobs are coming back. We saw the peak hit about 13%, and now it's closer to about 5%. And the ironic thing is that the number of jobs, there's almost more jobs than there are people. It seems like every place that you go to, every restaurant you go to this summer, there's not enough workers. So I think if you want a job right now, you could definitely get a job. And so what that is going to do is drive wages up, which is what we're going to talk about next. In terms of collections, we're seeing collections improve. People are getting money from the government in terms of rent relief. And then also the evictions are still allowed in some counties and some cities. And so that's allowing people the collection rate to improve. And then on the right-hand side, we're talking about inflation. This chart is just straight up in terms of core inflation. And, I don't think that's probably capturing everything, but whether you go out to eat or buying stuff at the grocery store, everything's more expensive right now. So inflation is definitely coming into play on the supply side, and then that should hit wages as well. And then in the bottom left, this is the GDP forecast from Moody's. They expect about 6% growth, 6.7% growth in 2021, and then 5% in 2022. So well above anything sort of that we saw sort of 2010 to even 2019. That was sort of about the 3% range. So the economy is humming along right now. This is all subject to the Delta variant that is approaching this fall. So, but in terms of Q1, Q2, the market is moving very fast and very well. And so, I mean, this has been, we're finally seeing this in the numbers. So Camden, which owns probably, I don't know, 50, 60,000 units, MAA also owns another 100,000 units. So these are large REITs that put their quarterly numbers out, and they just reported earnings for the second quarter of 2021. And look at these rent growths, these trade outs that they're getting, right? So new leases close to 9% on average, renewals 6%, 8% blended, same thing for MAA, 6 to 7% rent growth. So, Camden was saying that in 2020, we didn't raise rents at all, right? So they usually are typically clipping around 2 to 3%. They didn't raise any rents. And then 2021, that almost all came back, right? So the demand is high, occupancy is high. And so they're able to get, 9, 8, 9, 10% rent growth on a lot of their properties. And so the rent growth is finally coming. It's the summer of the multifamily owner. They're able to push rents. In terms of value add opportunities, this is what we're seeing more and more owners do. Larger players are doing it. And then I think it's going to trickle down to the BNC space. It's really the smart home technology. So whether it's thermostats, locks, things like that is one part of it. But the part of it that's going to drive more revenue is going to be the cable and internet rollout, and essentially forcing tenants to use your internet provider. And so once you, let's say it costs you $1,000 per unit to put it in, and then you pay the internet provider $15 or $20, and you charge the tenant $50 or $60 for internet. That spread that you make consistently is what we're going to see more and more owners do. And so we're seeing the other income line grow significantly on these properties that are adding this piece in there. Smart home technology, yes, but then also the cable and internet is a big thing as well. All right, so let's get into some of the data that we've seen sort of through the first 6 months of the year. 2021 has been pretty good for sales. It's on par with 2019, which was pretty much the highest year that is tracked in the last 20 years. So pretty good pace, if not faster than that. So Q1, Q2 is on a tear really compared to, Q2 last year was at 15.6 billion. And then this year is already at 52.7 billion for second quarter. So definitely out ahead of last year in terms of sales volume. And we're feeling that in DFW. This map, if you thought there was a lot of deals for sale in DFW, you were right. In the last 12 months, DFW is in the lead with 14 billion in transactions. So definitely a huge market. Austin at 5.7, Houston at 5 billion. And then really sort of your Sunbelt markets, Phoenix, Atlanta, rounding out sort of the top in terms of sales by market. Yield spread. So we've seen cap rates come down on average. This is still, it's probably not coming down enough. I can't really tell on this chart if it's 25 basis points or 30 basis points down from 2020. 10-year treasury is still sort of hovering around 130, 140. So there's still a good spread between your 10-year treasury and your cap rate. And so you can always go back to sort of 2007, 2008, and look how tight the spread between your cap of, let's say, 5% and your interest rate on a 10-year treasury of 4.5%. So if we start seeing cap rates are coming down, but if they definitely get within 100 basis points or 50 basis points of the 10-year treasury, watch out. And so this is cap rate by market. And you can see that, the only 5 cap on here was Orlando. Even that has turned down to 4.6. So pretty much you're seeing a range now. This is, I think, year over year, or over the past 3 years, pretty much all cap rates have come down anywhere from 30 to 40, maybe 50 basis points where they were in 2018. And so you're starting at 3% caps in some of your major markets like New York and San Francisco. And then, Austin's at 3.7, Dallas at 3.9, San Antonio at 4.1. Can't see if Houston's at 3.8 as well. So you're all in that sort of mid to high threes in terms of cap rates right now. And so this is what's driving that rent growth. So we touched on the rent growth. You're seeing the trade outs of 7, 8, 9%. And it's really being driven by the demand, right? So you see the demand here in Dallas on the right bar. That's the absorption. So that's the actual number of units that are actually being leased. And then this is the new supply. So almost always this is flipped, right? So the absorption is below the supply, but you can see that in the last 12 months, the demand has outstripped the new supply. And so that's in Dallas, Houston, Florida, Atlanta, everywhere, pretty much except New York. So New York is still delivering 15,000 units, but the absorption has not come back in the last 12 months. But pretty much all the other markets, you're seeing demand just go way past the supply. So that's leading to the rent growth. So we touched on rent growth. I thought this was interesting by market. So you're seeing some of the larger cities struggle with rent growth under a negative rent growth essentially. So you see New York, San Francisco, DC, all with sort of negative rent growth. You see Dallas at about 5% rent growth. Let's see if you see some of the larger or the higher rent growth numbers are coming out of Phoenix, Vegas, even some of the spots in Florida. You're seeing even top rent growth there. So, but you can see in terms of distribution, I mean, people are right. The most markets are in that sort of 5 to 10% range in terms of rent growth. And so multifamily owners have waited since COVID hit, and they had not seen rent growth until really the last probably 3 to 6 months of this year. So all right, so that's sort of the market update of where we're feeling. So we're feeling pretty good and about the market in terms of rent growth, in terms of occupancy. So let's talk about sort of the financing options and how people are able to buy in this market, because there's a lot of transactions happening. And so if you compare last year, so we saw almost no sales really in Q2 of 2020, but then Fannie and Freddie still did a ton of volume, right? So they did $40 billion in second quarter of 2020. And then second quarter of 2021, they did about half. So they're down 40%. And you're saying, well, there's more transactions. Why didn't they do more? A lot of this was refinance business in second quarter 2020. And then second quarter 2021, there was a new entrant into the game, and that new entrant was the non-recourse bridge lender. So at the beginning of 2021, non-recourse bridge lenders really started quoting aggressively, trying to win business, whereas they were essentially on the sidelines in 2020. So this year has been really a lot of non-recourse bridges across Old Capital. Really, second quarter, we saw probably 80% of what we did was non-recourse bridge. So this is 5 million and up and floating rate debt, and it can go 75, 80% levered on your purchase price. So we're seeing a lot of bridge lenders come into the market. This is one agency lender in their second quarter sort of earnings call. They did about 1.3 billion in loan originations on the agency side. And then if you look on their loan originations on the bridge side, it was 1.84 billion. So think about having a Fannie Freddie license and being able, one of only 10 lenders to do that, or have that license, and then you're still not winning business, and you're doing more bridge lending than you are agency business. So that is what we're seeing, and we're seeing rates continue to come down. It used to be maybe 4%, now it's 3.75, then 3.5, then 3.25. So rates are coming in on bridge lending as well. They're really getting backed up with the number of loans that they're doing. So they're going to keep pushing up the minimum in terms of what they will look at. So, it used to be a $5 million minimum. Now it's probably a $10 million minimum that we're seeing on non-recourse bridge lenders. And you're getting those rates of anywhere from 3.25 to 4% based off of the leverage. So if you do maybe a 70% levered deal, you might get a lower rate. If you do sort of full 80% of purchase, 100% of rehab deal, then you might be 3.5 to 4. But then once you drop down below 5, for sure, even below 10, there's just less guys bidding for that business. And so your rates are going to be higher. So you might be 4, 5%, even 6% on your rate if your loan is probably under $10 million right now, just because of the amount of capacity that these bridge lenders have. All right, so here's an example of, let's say, a larger deal, $30 million, and what we're seeing, right? So you're not getting full leverage on Fannie Mae, so you might be at 70%. Freddie's a little bit more conservative sometimes on taxes, so they're at 65%, and then non-recourse bridge is sitting up here at $24 million. So they're $3 million higher than you. And then inbred, so this is a new entrant into the game, is Fannie has come out with a floating rate product very similar to Freddie. So very similar to Freddie conventional. The Fannie floater is essentially similar pricing, but it will be what you'll have to do is probably get that quoted with your DUS lender, but then also they're going to have to submit it for approval with Fannie Mae. So you'll have to go through a similar process as Freddie, but I think it'll be a little bit more streamlined, and you'll have a little bit more control of the process with the Fannie floater. So we're doing a couple of those right now, but Fannie and Freddie are, $2 to $3 million short of this non-recourse bridge. And so a lot of people on acquisitions are using non-recourse bridges. And then once that is available, once they're able to refi, they're able to take it to Fannie and Freddie once they get the income up. So non-recourse bridge is really looking at your pro forma income and not historical income, whereas Fannie and Freddie are looking at historical. All right, so these are some of the items that you need on the non-recourse bridge. We're doing a lot of these right now. So just having these items ready to go as you work with your lender, I would say, the standard T12 rent roll OM, but then also your CapEx budget, your pro forma cash flows. And then they're going to really look into All right, you're saying you're going to take rents from $1,000 to $1,200. How are you going to do that? What's your rehab plan? And then what's the rent comps in the market that are going to actually show that amount? Some of the things to look at when you're reviewing, you're going to need an interest rate cap. And then also, I would also figure out what's your guarantor equity requirement. So that ranges also, but I'm trying to think if there's any. So on, and then probably also the lockbox is a big differentiator between on bridge loans. So look at those items while you're reviewing bridge loan applications as well. All right, so we talked non-recourse bridge. Let's go over to Fannie Mae. So Fannie Mae essentially is the same. They really haven't changed their program. 10-year treasury has come down. Their spreads have come down a little bit, so that's improved their terms. And then this Fannie Mae floating rate is really for loans above 15 million. So on larger transactions, you can go with the floating rate option. And then if let's say it's a lower deal, let's say a $10 million loan, you can still do a 10-year fix, 7-year yield maintenance, or even a step down prepay. So if you don't want to get on yield maintenance, you can still do step down prepay. So here's a look at sort of where rates were at the beginning of the year. So pretty low, low threes, and then it popped up with the 10-year rise in 10-year treasury, and then they have come back down to probably 3.25 to 3.5 on the interest rate for August, and then the floating rate. So these are going to be larger loans on the Fannie side are probably 2.6 to 2.7 on the floating rate side. So that is a pretty strong rate with 3 to 5 years IO and gives you a 1% prepay. So it's actually a pretty good deal as long as you can get to. So this one was sizing to 68%. But let's say that whisper price was 62 million and it was 68%. But then if the whisper price or if the pricing actually goes up, throughout the best and final process, you might be at 65%, then 60%, then 55%. So that's going to get away from you and it's going to make you bring more and more equity. So it's going to be harder because Fannie, essentially, that loan amount is not really going to go up from there. All right, this was a non-recourse Fannie Mae loan that we closed, I think, back in April. 224 units. We did, 10-year term, 5 years IO, and then we did the 10-7. So that gave them more flexibility. I think this one was around 70% levered to get to the proceeds that they needed to on this particular deal. So right now, there's no requirements on the conventional Fannie Mae product for reserves. So all the COVID reserves are gone. The student, if it has a student concentration, so I would say probably over 25% student, you're probably going to still need reserves, and the same with senior. Anything with senior housing is going to need reserves, but all the conventional stuff is gone. If you had a Fannie Mae loan and you did put up reserves, you can request that they can be released now. So I would request those now if you have not. All right, Freddie Mac conventional. So this is really your floating rate product, starts at 7.5 million. This was the loan product in Q3 and Q4 of 2020. It still is doing well, but they recently increased their spreads, and so it's a little bit more expensive. So if you look at, all right, at the beginning of the year is maybe 315 spread over SOFR, then it went down to 260, 265. So we closed 2 or 3 Freddie conventional loans, and their starting rate was 260, 265. But they have come in and increased their spreads by about 20 basis points just in the last couple of weeks. So it's still under 3, but it still is not. They're still using the in-place income for underwriting, which is hurting your leverage on a lot of these acquisitions right now. All right, so when you do a floating rate loan, you have to consider, all right, where is the base rate or the index that you're going to be, your loan is going to be floating on, your interest rate is going to be floating on. And so most loans on Fannie Freddie side is SOFR, on bridge loans are LIBOR, right? So if you go back to 2020, they weren't expecting LIBOR to go up and to hit 1% until really 2028, which was very cheap interest rate caps. But now, just with the amount of inflation, we saw that chart of the inflation, the amount of money that they're putting in the system. they're seeing, 1% being hit, probably 3 years from now. And so if you go in and buy a 1% strike, that cap provider might actually have to pay you. And so this is getting more expensive. So here's an example. This is a $17 million loan. If you buy a 2-year cap, right? So if you buy a 2-year cap, so basically from here to 2023, then you're pretty good. Like you're not hitting that forward curve. And so the pricing's pretty cheap, right? So $25,000 to $40,000, depending on the strike. But then on the 3-year, that's where it almost triples in price. So if you want to cap your interest rate out here, it becomes more expensive. And so that's what we're seeing on the interest rate cap pricing. But non-recourse, we closed this back, I think in April, May, or June, second quarter, and it was a floating rate plus SOFR, 70% LTV. So you can see that Fannie and Freddie are not doing full leverage deals, 10-year term, 5 years IO, and then 1% prepay. So that is Freddie conventional, no reserves right now. So all those reserves are out. So if you have a Freddie conventional loan, I would request that your reserves be released if you originate that loan in the last, post-COVID. All right, so we hit non-recourse bridge, Fannie, Freddie, and now let's touch on Freddie Mac Sbl, as this is still a competitive program for really 1 million to 7.5 million. This works well. So they are tightening on the underwriting a little bit. So they're more focused on local sponsors and having experience. So the experience can be 2 years total, and they also want you to have at least 3 properties. So every deal is going into Freddie. These rates have actually been pretty good because 10-year treasury has come down. And so it's based off of 10-year treasury. So this was a deal that we did, actually got to 75% a purchase, 7-year loan term, 2 years IO, and then a step down prepay. So the nice thing about Freddie Sbl is that it gives you a fixed rate, has a step down prepay, it's non-recourse, and you don't have to buy an interest rate cap. So that interest rate cap cost of $20,000, $30,000, $40,000 is gone. So here's some quotes on a recent $7 million loan amount. They're anywhere from 3.4 to 3.8%, depending on your debt service coverage and then your prepay term. So has a step down prepay. These guys still have the debt service reserve. So of all the agency loans, conventional Fannie, conventional Freddie, those are gone. But on the Freddie Sbl, so the smaller loans, they still have this debt service reserve. So that's what this chart will cover, is the debt service reserves. Really on acquisitions, it's going to be 6 months. So if you're at a 120, 125, it's going to be 6 months of your P&I. And then on the cash outs, on the refis, they're going to want 12 months of debt service reserve. And then if you're acquisitions, but it's lower leverage, so say 65, 140 on the coverage, then they're not going to require the debt service reserve. So, and they want really these to be top in standard markets. So, Dallas, Austin, San Antonio, Houston, those will be fine. But if you're 2 hours outside of a major city, then you're probably still going to have a 12-month reserve on your Freddie Sbl loan. All right. So it's been a busy couple months this summer, just closing transactions. Just run through these really quick. So Hollyoaks was a non-recourse bridge. Uptown at Cole was a non-recourse bridge. Century Oaks was a Freddie conventional. Rancho Joyce Lane was a recourse bank loan. Diamond Lock, we talked about non-recourse Freddie Mac conventional. Villa Gardens was a Fannie Mae refi. Courtyards was Fannie Mae, and then Heritage was a Freddie Sbl. So as you can see, the mix sort of at the beginning of the year was more Fannie Freddie, and then towards the end of the second quarter, we started doing more non-recourse bridge loans across the portfolio. All right. So Old Capital, what we do is we are a mortgage broker. So depending on what loan type you're looking for, so whether it's Fannie, Freddie, bridge, CMBS, HUD, construction, we sort of review all those and figure out the best option for you, right? And so, a lot of people might say, oh, okay, I know this one lender, let's go to that guy. And that person might have sort of one product, right? So if they only have Fannie, or they only have Freddie, or they only have bridge loans, at certain points in the life cycle of a deal, it might need different things. And as the market changes, as we've seen in the last just 12 months, Fannie and Freddie might be the best execution, and then it might jump over to bridge. You have to know what the actual deals are happening in the market and who's being the most aggressive in the market. So in terms of loans available, that's what Old Capital can provide. And then in terms of before the deal, whether it's education, whether it's helping you win deals, helping you quote deals, we can do that. During the deal, definitely joining you on the property, walking the property, introducing you to vendors throughout the process, really being a second set of eyes for you throughout the process, and having somebody on your team representing you and not the seller, not anybody else during the deal. And then after the deal, really highlighting your success, right? So as you come in and improve the property, whether we have you on the podcast, whether we have you at our conference, those small things really add up to a lot in terms of getting you exposure to either more investors or more listing brokers, so that you can grow your business. And then we charge 1% of the loan amount at close, like everybody else. So our next big event is going to be September 22nd, 23rd. First night is a happy hour at Texas Live. And then the next day at Globe Life Field, we will be actually on the field with some of the top speakers, whether it's listing brokers, lenders. One of our keynotes is going to be Ivan Rodriguez, the former Texas Ranger, Gold Glove, MVP, World Series champion, joining us on the field at Texas Rangers Stadium. So if you want more information about that, go to oldcapitalconference.com and you can learn more about that. So there's my background. And then, so a couple things. If you like this video, definitely subscribe to the channel, like the video, comment below with any questions or feedback. And then if you need help with a particular deal, what I'll need is the T12 or trailing 12 income statement, rent roll, OM, and then whisper price, and I can create a loan term sheet for you. And then if you're looking at a deal from either a limited partner or investment standpoint, and you want me to review it, you can send that to me as well. Whether you get a package from a general partner, I can review it and let you know sort of pros and cons and questions you can be asking. And then if you're just getting started, right? So if you are new and you want to just sort of get pre-qualified, send me an email. I'll send you sort of a personal financial statement, our white paper that we have that can give you some of the high level on financing. And then we can set up some time to talk, to discuss buying, selling, or refinancing your first deal. All right. Here's my contact info on the side, and I will see you guys on the next video.